Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
What's up, everybody? A lot of familiar names this week, which I'm excited about. That's why I like doing this back to back. I get to see a lot of you again. Those of you who are new, this is a webinar we do every single Tuesday. We call it Take Back Control Tuesday, where we go over the money multiplier concept, a way that billionaires and the wealthiest families in American history have used whole life insurance actually to become their own bank. It might sound a little weird at first, but we'll dive into that presentation today and go through everything so you understand the basics to the complexities of this strategy. Those of you who are new or not new, coming back for more, I love that you're here. The more you are around this concept, the more you hear the same thing over and over and over again, it will eventually click. If it hasn't already, I like to think it usually takes about 8 to 10 hours to be around this to really get it and have your light bulb switch. And so even if this is something you've already heard before, keep coming back, because every time you hear it, you're going to get something new out of it. You might hear some of the same things and some might be repetitive, but other things are going to be brand new that'll help you click the pieces together. And it's going to be the most impactful thing for you guys to do to really understand and grasp this strategy. So Anthony, again, I saw you messaged again. Thanks for being here. And I'm sure you'll have even more important questions this week. So all of you that are new, just to give you a heads up, this is going to be about a 45-minute presentation, hopefully. We're going to dive into infinite banking, to dive into some wealth-building concepts. And I want to have a very interactive chat today, just like we did last Tuesday. So I love that you guys are sharing where you're from. I see you're from Little Downey, California, in LA. I'm just south of you. Just in Orange County, and I saw a couple other people from California as well. So let me know again where you guys are from. If this is your first time, second time, 100th time you've heard this presentation. Let's see. We want to talk a lot today, guys. So give me thumbs up throughout the presentation. Give me questions throughout the presentation. Give me just your enthusiasm and feedback. The more you guys can contribute, the more you're going to get out of this. So I'm grateful for you all being here. We're going to talk today about the money multiplier. And if you guys are ready, let's get into it. So you can see my screen, right? Where I have the green screen here, the money multiplier. Okay, awesome. Let's move over then. All right, so here you go. We're going to talk today about how you and I can become our own bank. So a question I often get when presenting this is, why would I want to become my own bank? How can I become my own bank? Well, keep those questions in your mind throughout this presentation, because that's what this is all about. And it's going to take some time for your mind to shift while we're going through this. And so I'm going to try and dismantle everything you think you know about money and you think you've been taught. And then as we're at that ground level, the foundation, I'm going to build you back up the right way and teach you this. And so it's not until we break down and understand the basics that we can really see what we're doing with this. And this is really going to make sense after that. So let's dive into that. Again, I see thanks for the comments. A lot of first timers. That's awesome. This is your first time. I'm excited for you. This is going to blow your mind. And today we'll start with control. Control is one of my favorite topics to start with, because if you don't control a few things in your life, other people will control it for you. Those few things I refer to are time, your mind, and your money. You need to control your time, mind, and money if you want to become successful. And what's the most important to control? To me, it's our mind. Because if you can't control your mind, you can't control money. And if you can't control money, you're not going to control your time. So as we go through this presentation, we're going to be talking about how to control our mindset around money, so that when we do talk about becoming our own bank, it makes sense. So as we dive into this, again, this is a 200-year-old system. That's probably the most powerful way of saving, creating, growing, and preserving wealth than anything else. And you don't have to work any harder, any longer, or really change anything except where your money goes first and how you view banking. So let's start today with statistics. Let's talk about the 5%. You guys here are the 5%. You're here taking time out of your Tuesday afternoon, or if you're watching the replay, out of your day, to learn about different ways to impact your future. And that's pretty freaking awesome. If I was to go around and ask 118-year-olds, ask them, hey, if you were going to be wealthy and successful at age 65, would you? I guarantee you every single one of those 18-year-olds would say, of course I will be successful at 65. I have so much time to fulfill that. But something happens from when we're 18 to 65 that changes that whole dynamic. According to the Social Security Administration, this is real numbers from our government, 5 out of 100 people will be financially secure at retirement age. And I'm not saying wealthy, rich, successful, just secure. That's a pretty small number. We live in the USA, the land of opportunity, the land of entrepreneurship, building businesses, buying homes. Why is it only that 5% are even secure? There's a lot of reasons why. We could dive into that. But that means that 95% of people are going to be working until they're 70, 80 years old, taking up 2 jobs. Not because they want to, but because they have to. So I want you guys to know that because you are here today, if you act on what you learn, you will become a part of that 5%, hopefully a part of the 1%. And you're not going to be like that 95% of people that are not here today. So let's dive into some serious 5% stuff. Starting with this question, why aren't more people successful? Right, it's a very simple question. Everyone asks it. There's 2 things. There's 2 reasons, I would say, why people are not successful. There's wealth killers, and there's a mindset that needs to happen. First is our wealth killers: taxes, inflation, volatility. When you guys go out and work hard for your money, that money comes into the household. What's taken out first? Taxes, then your expenses, then your bills, paying other people. Then what's left, you try and save, and that's going to have to fight inflation and volatility of the markets and somehow make it out the back end. It's a very difficult system, right? And then to add on top of that, if you just follow the status quo, if you live in fear, and when life gets in the way, that's going to make it even more difficult for you to build wealth and be successful. And so I understand why only 5% of people do. It makes sense. But how can we not be a part, or 95% of people do? So how can we be a part of the 5% that's successful? This is where I want the chat to start livening up. Sorry, I haven't asked you guys any questions yet, but what do you guys think? What can people be doing to be actually not following the status quo, not living in fear, being able to find ways to fight inflation or pay less taxes and start saving more money? I think that's actually it. Saving more money. If you can save more money, you'll eventually have enough to, maybe be successful, but saving money is the key. So let's talk about this quote. That's my favorite quote. It's by a guy named Will Rogers, where he says, the problem in America isn't so much what people don't know. It's what people think they know that just ain't so. A lot of what we've been taught about money may not actually be the truth. But I need you to keep an open mind, because in this webinar, I'm going to challenge the way you think about money. For example, have you guys ever seen this video on YouTube? It's called the backwards bicycle. It's a very interesting social experiment that this guy does. He's looking to see, hey, I rode a bike my entire life. It's muscle memory for me, right? Well, he wanted to see if he changed the bike handles to be in reverse order, he'd be able to ride the bike still. So that when he turned the bars left, the bike went right. When he turned the handlebars right, the bike went left. Right. So that's what he was trying to figure out. He did that, flipped his bike around, the handlebars at least, got up on the bike, took a couple pedals and fell. He got back up on the bike thinking, I know how to ride a bike. I've been doing it since I was a little kid. Gets back up, pedals, falls. And he does this for hours on end until eventually he could do it. Eventually he could ride the bike backwards. And then the funny thing was, you'll see in the YouTube video, he tries to do it again the normal way of riding a bike, and he couldn't. His mind flipped to the other way of thinking about the bike. And it took him hours to ride a bike again. I tell you this story because when you learn something one way, it's very hard to change. And the same is true with money. Since we were little, we've been trained how to think about money. But what if I told you that what you were taught's wrong? It'd be very difficult for you to change to the new way of thinking, wouldn't it? But it wouldn't be hard. I mean, eventually you would learn how to ride the backwards bicycle. So earlier I mentioned that this is a 200-year-old concept, right? Well, people have been doing this for a very long time. The Rockefellers, the Rothschilds, the Stanley family, the Morgan family, Walt Disney, a lot of people use this strategy. But in the modern day, Robert Kiyosaki is one of the biggest business moguls, real estate investors in today's world. His book, Second Chance, he writes all about why he does this strategy. And then I know I mentioned, I clicked too far, but Tony Robbins, Money Master the Game, he talks all about this concept in section 5.2. And then if we get to the next couple books, all about IBC, Nelson Nash wrote Becoming Your Own Banker, which is all about the concept. And then these two books by our mentor, Chris Naugle, who you probably know being on this YouTube page, he writes his perspective on the concept and teaches it as well. Any of these books I would recommend to get to learn more about money, just so you guys are aware. And if you want me to send you a list of these afterwards, I can, or take a little snapshot photo right now. So really quickly, this is me. Those of you who are new, my name is Carson Herleen. Steven introduced me in the beginning. This is my wife, Anna. We live in Southern California, like I mentioned, where we love to be outdoors. We love to surf, actually. We love to travel. And about 3 years ago, I became my own bank. And this has allowed me to buy over $5 million worth of real estate, has given me the perfect foundation to build generational wealth. And my story is pretty simple, honestly. A lot of you probably can relate to it. In my early years, I made a lot of mistakes, as young people do. But I did do one thing right. At 18 years old, I went on a service trip where I lived abroad and served people for a year. And when I came home and I was in college, I had a lot of outside influences pushing me different directions. In one hand, I held a traditional schooling mindset, going to school, learning about economics, school, or math, English, all that kind of stuff, getting good at doing tasks and assignments. And on the other hand, I held real estate investing, entrepreneurship, freedom even. And I came to a point where I had to decide, do I want to work for money, a part of the rat race, or do I want to learn how to make money work for me? And it was that tension pulling these apart that brought me to a point of decision. And that decision to drop out of school and pursue a bigger game, the wealth game, has brought me extreme happiness and success already. And I am early in my journey. And so I'm hoping to share with you guys what I've been so fortunate to learn already. So I want to start today, this presentation, with, again, some questions, some mysteries about money. First being, what is the definition of money? You guys know there's a lot of different ways you can go about this. What would you guys think that the definition of money is? Freedom. I love that. Yep. 100%. A means of exchange. That's all it is. Essentially, you're trading money for food, food for money, money for car, car for money. Nothing more than a means of exchange. So what if I was to ask you this next question? Do businesses or do other companies use compound interest? What do you guys think? Most people think banks do, Wall Street does, but the answer actually is not one business. But let's focus on banks because they're the most common answer. Banks don't make compound interest. They actually charge you compound interest. They don't use it themselves. For example, if you were to go write your name on a $20 bill, walk into your local bank, give it to the teller, what do you think they're going to do with it? Go put it in the back with your name on it, put it in a little box for your monies? No. That money goes immediately into motion and they lend it out. There isn't a business in the world that uses compound interest, and nor do banks actually. Banks keep money in motion, just like you should. But you haven't been shown or taught how to do that. You've been taught to park your money and leave it in someone else's control. But today that has to change. Because if I was to ask you these two questions as well, what would you think? Are your dollars worth more today or in the future? Obviously, they're worth more today. How many candy bars could you have bought 20 years ago for $1 versus today? You can't even buy a candy bar for $1 today. It's worth more today. And what about taxes? Are taxes going to go up or down? And would it be better to pay tax on the seed or on the harvest? Taxes will always go up. Wouldn't it make more sense to pay tax on the small amount, not the big amount? However, a lot of us don't practice that because I bet you most of you have a 401k or an employee-sponsored plan of some sort. And what you're actually doing is when you put those dollars in that account, you're giving up today's dollar, which is worth more, in exchange for weaker dollars in the future. You're actually compounding the tax because the tax is always going to be there. And when you pay the tax on that money someday later, it's going to be on a larger amount. You're not paying tax on the seed, but rather the harvest. And that's the funny thing, because that's just what we've been taught to do, is just give up control of our money. And now it's normal. It should not be normal. We do things with money that we would never even do with things that money buys. Like, for example, would you guys ever go to your local grocery store? You walk in, buy a loaf of bread, come home, open up the freezer, throw the loaf of bread in there, and then wait 5, 10, 15 years, come back home, open up the freezer, take that loaf of bread out and eat it? You would never do that. It'd be freezer burnt. What if I was to say, I just went to the local dealership, bought a brand new car, I'm stoked about it, drive it home, park it in the driveway, and then I wait 5, 10, 20 years to drive that car? I would never do that. That's exactly what we've been taught to do with our money. We've been taught to give up control of our good dollars today for weaker, higher tax dollars later. And if you want to be good at money, then you need to start changing who's in control of it. That's really it. So how does your money actually flow? Let's talk about some principles of money. I have a question for y'all. What do you think? Do you think it is possible that you can earn more money with 4% if you had to pay 6%? Could you possibly make more money earning 4 while paying 6? Those of you who were on here last week, you know the answer. You say yes, obviously, right? Someone said no. Well, it's a tricky question because those numbers don't add up, right? 6 minus 4 should be -2. But it's not totally the case. I'll give you a real life example. Let's say I had $25,000 and I was going to go buy a car, right? That's the average price of a car now. So 25 grand, I go to the bank and I say, hey, I have 25 grand sitting in my current savings account. Can I please take it out and go buy the car? He's going to say, wait. Why don't I just give you a loan for that car instead? And he'd say, I guarantee you're going to make more money in your savings account than you would paying on the car loan and interest. Doesn't sound realistic, but let's go through the math. So if you were to leave 25 grand in a savings account at the bank, that's this right one, by the way, and it's going to sit there and earn 4%. You have an amazing savings account that pays you 4%, right? You're stoked. If your 25 grand sits in there and earns 4%, and then you get a $25,000 loan from the bank at 6%, how is that going to play out? Well, that payment for a car will be $483. Simple car payment, right? 6% for 60 months, 5 years, pay off the car. That's how normal car loans are. Well, over that 5-year period, that's going to be $28,999 you would have paid for that car. Okay, everyone's following? Simple math. Your 25 grand sitting in the savings account after 60 months would be worth $30,500. Again, you can do the calculations yourself, very simple math. Why is this possible? Because of interest. When you're making a car payment, you're paying the loan down, you're paying the interest down, you're paying less and less. It's simple interest. Whereas the interest you're earning is compounding. You earned 4% this year. That sits in your account. Now you earn 4% on the 25 plus what you earned last year, and then plus what you earned the next year. It's compounding on itself. And so there's a difference. One's going to be decreasing, one's going to be compounding. So I just proved to you with math, you can make more earning 4 than paying 6. And this works with any example. If you're going to buy a $50,000 car, or loan rates are a little bit different, same idea. In this situation, he made $1,500 while he had the car. He got some of the interest back. That's pretty cool, right? So that's what we're going to dive into today. That was all the framework of how our mind needs to be understanding money, why it makes sense, or who's doing this concept, and why it makes sense you can even earn more while paying more in interest. So today we're going to be talking about the money multiplier method. Let's dive into some of the big details with all of this, the numbers. So there's 3 things that are involved when it comes to this method: the machine, the marathon, the millionaire. We love alliteration over here. That's why we're the money multiplier, obviously, right? So what do these things all mean? Well, there's a machine. There's something your money has to flow through to make this work. And then the marathon. This is not a sprint. This is a long-term plan to build wealth and build generational wealth. This is not a get-rich-quick scheme. This takes time. And again, the millionaire. This is just the goal, our favorite topic. What if that's being a millionaire, multimillionaire, business owner, having time freedom, having a land of your own? Whatever your goal is will be incorporated in the concept as well. And a question that I like to start with is, could it be possible that there are more efficient environments to store wealth outside of commercial banks that we are not already aware of? Think about that for a second. The answer should be yes. So this is a powerful question because I want you to think about what you're not already thinking about. What have you been taught? And I hope when it comes to money, we can even have a humble and learner mentality throughout our life. In our culture, we don't value a savings. We don't value the retention of our dollars or the control of our dollars. And one of the reasons I'm convinced that Americans are not saving money is because of the environments that we are told to store money. These environments like savings accounts, high yield savings accounts, CDs, 401ks, they're so incredibly inefficient. It's hard to save money because the money doesn't really do anything when they're there. So could there be a more efficient place to keep money? That's what this machine is going to be. And we're going to talk today about the function of banking, right? So when we're talking about your bank you're setting up, this is going to be the machine, in other words. This is a paradigm shift for most people. The interesting thing about banking is that it affects every single component of your life. So wouldn't it be smart to learn a little bit about the banking function and how that actually applies in your life? So when we set up this new bank, we're replacing our old one. You're replacing your current account at someone else's bank. Anytime you ever need to buy anything, invest in something, pay off a debt, it's going to come from and to your bank. So let's talk about what your bank is and the attributes of it. First off, it's liquid. How cool would that be? If your bank you're setting up's liquid, right? Just like your Wells Fargo or Bank of America account, your money's completely liquid. Beautiful, right? What about interest? The average savings account today is actually 0.07%. It's pretty pathetic, right? What if I could tell you your bank was going to make 2 to 6% every single year, uninterrupted and compounding on itself? Remember the importance of compounding interest? And what if I could tell you that that was going to be tax-free? You are taxed on the tiny amount of interest you earn in your bank account. What if I was to add to all of this that you are protected? If you were ever in a lawsuit, judgment, lien, your money's safe. And what if I could tell you it was stable? In times of economic uncertainty, your money's safe. Now, wouldn't you say this is a very efficient place to store money? This is a place you can control, you can count on, you can use as your foundation to finance everything you need throughout your life. So let's dive deeper into this. What is your bank? What is the machine we're going to use for this? The machine is nothing other than a dividend-paying whole life insurance policy from a mutually owned company. Now, what the heck does whole life insurance have to do with building wealth? Some people think whole life insurance is a scam, right? That's what Dave Ramsey says. This is what the rich and the elite are doing. If you don't believe me, let's talk about who does. You guys know this man right here in the top left, Mr. Rockefeller? He built his oil empire and his generational wealth of even his family today has money because of this concept. He used whole life insurance in his business. On the top right, you see Mr. Walt Disney, Disneyland, right? How did he start Disney when he was broke during the Great Depression? Through his whole life policy. How are these two guys on the bottom right? Today's modern business moguls. Warren Buffett, one of the smartest investing minds in the country, the world. They have billions of dollars of life insurance, whole life, not IULs, not term, whole life. And these two politicians on the bottom left, there's so much political drama right now. I don't even want to get into it, but both of them are wealthy, no matter who you like. Both of them have whole life insurance. Both of them have millions of dollars of whole life insurance. And not just that, this is the funny thing. The number one purchasers of whole life insurance in the country is traditional banks, everyday known banks. So if you look this up and write it down, BOLI, BOLI, bank owned life insurance, that's what it stands for. But what you will find is that banks own more whole life insurance, again, not IULs, not term insurance, whole life, than they own in land and buildings combined. They're the number one purchasers of whole life insurance in the world. And not only do they own more whole life, banks continue to keep buying more. So you got to ask yourself, are banks stupid or do they know something that we don't know? I mean, look, between these four banks, there's over $60 billion in whole life. That's freaking crazy. They're not stupid. They're smarter than I am, smarter than you are. They know on the insides of the government and the country what's happening and where the safe places to store money are. All we have to do if we want to become our own bank is mimic what the banks do. So how do banks actually operate? Let's give you a real life example here. If I had $100,000 and I deposited that in my bank, and that bank is paying me 4%, right? And I do see a question real quick about whole life. Just so you know, keep that question. I will get to it at the end when we go through all of our questions, but that's a fabulous question. So we'll talk about it. So if you had a savings account that paid you 4% and you deposited 100 grand in there, stoked, right? To you, you think that is a asset because you stored money there and it's available. To the bank, that's a liability. They want to get that money out working for them. So that's what they do. When you deposit your 100 grand, they're going to go lend it out somewhere else to your neighbor down the street who wants to buy a home. They'll lend the house, the 100 grand to them at 7%. And then what's the seller going to do when they get their money? Put it right back in. And then what's the bank going to do when they get the money again? They're going to go to someone else and lend them on a car at 8%. And they're going to pay the car dealership who's going to put the money where, right? You're getting this. Then the bank's going to lend the money somewhere else to someone who needs a home remodel loan at 9%, who's going to pay the contractor, who's going to put the money back in the bank, hopefully. Last example, let's say you go get a large amount of debt, you got to pay it all off, and you're a debt consolidation loan at 12%. You got to pay all your credit cards off, but where are the credit card companies going to put the money? Right back in. Look at this picture for a second, guys. Who is in control of all of these transactions? Who's taking the least amount of risk? Who's making the most money? The bank. When you're making 4, they're making 7. They're making a 3% spread. When you're making 4, they're making 8. They're making a 4% spread. When you're making 4, they're making 9. When you're making 4, they're making 12. If you total all of those up, they're going to make 20% more than you are on your money. Okay. Some would think that means you make 16% more, right? 20 minus 4 is 16. 4 goes into 20 5 times. The bank is making 5 times more than you, which is 500% more than you are. If you go to bauerfinancial.com, you will read that banks make between 400 and 1,300% annually on the money you leave there every day. So earlier when I told you banks are the number one purchaser of these specially designed whole life insurance policies, the thing I asked was, are banks stupid or do they know something you don't know? You probably should know now. They know something you don't. So banks know a lot, right? They know a lot about statistics. So let's get into some statistics. They know about the annual pattern of spending. How do us as Americans spend our money? This is straight off of an actual report. 20% of every dollar Americans make, on average, goes to automobiles. Crazy, right? 20 cents of every dollar you bring in the household. And then it shows that usually 30 cents of every dollar brought into the household goes to housing. That would leave 40 cents of every dollar brought into the household, 40% of your income, going to everything else. Travel, entertainment, food, everything else, right? That would leave us with a solid 10% to save. How many of you guys are actually saving 10%? I hope a lot of you are. I hope you're saving at least 10% of your income. That's law number 1 of wealth. If you're not, I think that should be your goal. I don't even care about this presentation. Go start saving 10% of your income. If you can save more, awesome. But this is what happens in America. And actually 10% is a little high. The average as of like 2024 is closer to 5%. Most of financial advisors talk to us about the money that we're saving. And now we can make more money on the money we're saving. But to make more money, you need more risk. Do you really want to take more risk? How much more risk do you want to take on your money, on the small amount you save? If you can't save more, you don't want to take more risk, then what options do you have? How much more risk do you really need? I'm just telling you guys what's really going on out there. And so today I'd rather talk to you about what you're spending and show you how you can build wealth by simply taking back control of the money you're usually giving away. If you want to build wealth, look at where all of your money goes and find a way to take back that, find a way to control it. So let me show you what that would look like if you did so. Saving 10% of our income, 20 cents going or 30 cents going to a automobile payment. No, it is 20. Sorry, 20 cents going to automobile payment. Of that 20 cents of your income going to a car, usually 5 cents of it goes to interest. Okay. So if we stopped paying interest to other people, that would increase our savings by 5 cents. That's 50% increase in savings. And let's talk a little bit about interest really quickly. If you pay cash for, or if you get a loan for a car, you're going to make payments with interest, right? That's where that comes from. But even if you buy cash for a car, you're that person. Awesome. You're now giving up the money to go buy a car. You could be earning interest on that money you just spent. So it's called an interest cost. You're giving up the opportunity to earn interest on that money ever again if you pay for it with cash. And that's not interest for 1 year or 5 years. That's interest for the rest of your life you're missing out on by paying for it with cash. So either way, there's an interest cost. Let's talk about housing. If 30 cents of every dollar you make goes to housing, it's a crazy stat, but 25 cents of it actually goes to interest. Isn't that absurd? Look at how much you're able to save now by stop paying other people interest, by stopping. When you go look at your mortgage payment, your statement every month, what portion of that's interest? I don't care if you have a 2% mortgage rate, a 3% mortgage rate, a 5% mortgage rate. I guarantee you over 80% of your payments going to interest. Look at your payment right now. You will see. You know why banks do that? Again, because they're smart. They know people move every few years. So of course they're going to front load the interest in the first few years. So guys, it's not about the interest rate when you're buying a house. It's about the volume of interest you're paying. And if we keep going with this example, 40 cents of every dollar goes to everything else. 5 cents of that usually goes to interest. Now look at how much you're able to save, about 50% of your income, by just changing who you're paying the interest to. So again, I told you I'm not talking to you about saving more money, because of course that's great. Everyone can do that. But if you can be the bank, pay yourself interest, look at how much more money you can save. So how we spend money is how you can essentially start being better at building wealth.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
So this is a sweet truck, not mine, I wish. But we're going to talk really quickly now about how you can actually build a policy to finance things and buy things and show you real life numbers of what we're talking about today. I'm going to show you how you can get all the money back for every car you ever buy, drive, and own. And we're going to start with the machine, with this policy. Okay. This is a illustration of it from a policy from an insurance company on this right side, but there's a lot of numbers there. Don't get confused. Don't even focus on this. I'm going to show you this in like 2 minutes. So wait a second. But when we look at this machine, this policy, you need to understand a couple of things. First off, the premium. Usually, people look at whole life insurance or any insurance as a premium payment, a bill, just like health insurance and car insurance. Normal life insurance, yes, is like that. But again, this is a specially designed whole life insurance policy. So we look at the policy more as a deposit, not a premium, because when you go to the bank and deposit money, it's liquid right away, right? And you never think, oh, I wish I deposited less in my savings account. No, you always want to deposit as much as possible. So if your policy is structured correctly, and it is a deposit, then wouldn't you want to start changing the way you think about a premium? You want to deposit as much as humanly possible. Now, what if I was talking about age? A lot of people say, I can't get a policy. I'm in my 60s or 50s, or even some people say, I'm too old. I'm in my 40s, which is funny because they're so young. But they think that because normal whole life insurance, again, yes, age matters. But when we're building a policy for banking, it does not. If I tell the insurance company, my person My client wants to put in $10,000 a year into the policy. I don't care if you're 60 or a policy on a 10-year-old. We're putting in 10 grand a year. We pick how much we're putting in. So don't get hung up on your age. Anyone can do this. And same with the death benefit. We are using life insurance. There's a death benefit on the policy, which is fabulous and a way that families really build generational wealth as they pass that legacy down, but don't get hung up on the death benefit. We're not doing this policy because of a death benefit. We're doing this for the banking aspects and the cash value. So I'm going to minimize the death benefit and maximize your cash value so you can use this policy to do banking with. This is, again, just a machine for us to become our own bank. This is not a life insurance policy the way we normally look at life insurance. So that background knowledge understood, let's talk about how we use this machine to buy a car. So here we go. All right. This is just a copycat of that previous page with that illustration. So let's say this person deposited $10,000 every single year into his policy. Don't get hung up on this number. This could be $100,000 a year. This could be $500 a year. Okay, just 10,000 is an easy number. The cash value column in the very far right shows you how much money is accessible and liquid to this person each and every year. He has $6,000 essentially available in year one, about 60% of his funds. Year number two, the total cash value is $12,000, right? A little bit more. Year number three, it drops to $4,000. The reason it does that is because we're going to show you an example of buying a car. So in year number three, he takes out 25 grand to go buy a car. So that should show 29 grand, just so you're aware. But it shows 4 because we took 25 out. All right? Does everyone follow? And by the way, we're going to get into a lot of numbers over the next 10 minutes. So if I'm going too fast, please stop me and I will explain more. Okay. All right. We're good. So no questions. She takes $25,000 out to go buy a car. So what are you going to do? If you were to go get well, actually, really quick, I'll make a point here. Your premium are deposits into your policy, right? That's always going to sit with the insurance company. And remember what I showed you in the beginning. Every dollar you put into here is going to be liquid, guaranteed to grow, with interest, tax-free, protected, stable. Remember that page in the beginning? Amazing environment for money to be stored. So 10 grand a year is what they thought they could save and put aside into their policy, okay? Now, as their money's sitting there compounding, the insurance company said, great. Based on this money you have, we'll use it as collateral and we'll give a loan to you. This loan is the cash value. The cash value is how much money you have access to utilize in your policy. That's what's liquid. But if you take it out, it is a loan. It is a loan against yourself that you pay back to yourself. You take it out, you repay it, you're just filling up your cash value account, okay? So your premium dollars are always sitting in this policy compounding, and then you're leveraging it via the cash value. So that's what they did. They took $25,000 out as a loan against themselves to go buy a brand new car. Now, what do? If they take a loan from themselves, shouldn't they pay themselves back? If they're going to get a loan with their local bank paying them a payment with interest, why would you not treat yourself the same way? You don't want to steal from yourself. So let's show that. Let's say, hey, he takes out 25 grand and pays himself back $500 a month for 60 months, just like he would pay anyone else. And again, this repayment, $500 a month, is going to just refill back up his cash value account. So let's total this all up. He deposited $70,000 as a premium, $30,000 of loan repayments. He put in 100 grand into this policy over that 7-year period. And then he took out 25 to go buy a car. So his net injection into this policy is 75 grand. But take a look. I should have a red underline, but look, I should be underlining right now 67,881. The cash value in year number 7, he has $67,000 liquid available in his policy, right? And he put in 75. That would mean he had access to 91% or 91 cents on the dollar of every dollar he put into this over that span. He put in 75, he had access to 68 basically. He had access to over 90% of what he put in. The cool part about that is he also bought a car. So he really got 91 cents back on every dollar he put into a brand new car. Just letting this soak in for a second. But I told you that you could get all the money back for the car, right? So I'll show you that. Let's say he continues to run money into his policy and he continues to buy cars. 5 years later, after he bought the first car, his wife needs a car. They needed a brand new car, right? So that's what they're going to do. They deposit no more premiums and they take out a loan from their cash value for 25 grand to go buy another brand new car, which they're going to do what, guys? They're going to pay themselves back and pay themselves back what they would have paid anyone else, $500 a month for 60 months. So over that new 5-year period, they put in 30 grand as a loan repayment. They also took out 25 grand to go buy a brand new car. So he put in 5 grand net into this policy over that next 5-year period. And look at how much the cash value grew by. Year number 7, that total cash value is 67 grand. And year number 12, after he got the car, the cash value is 91. That means that his cash value increased by $23,500. Right there in the big red numbers. 23 grand the cash value increased by in that 5 years. And he put in 5. He just made a lot of money off of buying a car because he financed it through his own system. And look, over the whole time period, over 12 years, he put in 75 grand in the first few years and put in $5,000 in the next couple of years. He put in 80 grand into this policy, and look how much cash value there is at the end of 12 years, 91. He has access to more than what he put in, and he has 2 cars fully paid for, living or sitting in the driveway. He made money off of 2 car purchases. The reason this happens is because his deposits, that 7 years of depositing money in, that's always sitting inside the policy, compounding interest. So you have an amount of money that you're constantly contributing to, constantly compounding, growing. And whenever you want, you can just leverage it, take a loan against it to go buy things, finance things, and pay yourself back. So money's sitting there compounding. He's taking money out, putting it back, taking it out, putting it back, taking it out, putting it back. Just over and over and over again, moving money in and out of this cash value. And his dollars are still compounding while he's doing that. Now, this might be confusing because this is your first time learning about this. So let's give you some more examples that hopefully will clear it up. There's 3 rules we use when we do this. Rule number 1 is pay yourself first. This person saved 10 grand a year. And instead of putting it in their Wells Fargo account, they put it in their policy, their bank. Rule number 2, pay yourself back with interest. If you're going to pay someone else, you should pay yourself with interest. Rule number 3, recycle and recapture your money. Because wouldn't it be nice? Wouldn't you agree that it'd be better to pay yourself interest than the bank? You'd get a lot more out of that interest if you did that, right? So if this works for a car, what else can it work for? Everything. That's the cool part about being your own bank. You can finance everything throughout your life through your own system. Now let's go through some other examples. Like I said, let's give you a debt example. I don't know how many of you guys on here have debts, even if it's just one mortgage and a car, or if it's a bunch of credit cards and a car loan or whatever, right? If you have any debt, this might relate to you. This was a chiropractor we worked with on our team. He had 9 different debts between credit cards, private loans, cars, boats, houses. I'll skip through this. Yep, total of $478,000 of debt. That's a lot of debt, right? He made a lot of money though, so that's why he accumulated debt. He spent more every time he made more money, which is not smart. Should have been saving, but that's what he did. He now learned his lesson. He has about 500 grand in debt. That was paying about $5,700 a month, every single month in debt payments. Could you imagine? That'd be so stressful. It was going to take him 19 years to pay off all of his debt. Okay, so that's the framework. He told us, hey, I actually save about 2 grand a month. I get that paid to me in cash every single month. And so it's kind of money I just put on the side. We said, great, put that inside of your policy. So he did. He put 25 grand a year, about 2 grand a month, into his policy every single year instead of keeping it in his current bank account. And then we thought, all right, well, how can we use this money, the savings, in the most efficient manner to pay off his debt? So that's what we did. Put in 25 grand. The cash value he had access to utilize in the first year was 14. Again, about 60% of what he put in. So he takes this $14,000 out right off the bat and paid off those 2 credit cards and a little bit of the Nordstrom card. But what is he going to do when he pays off those 2 cards? He took a loan from himself. He needs to pay himself back, right? So he put in where he was paying $161 a month for his Discover card and $287 a month for his Lowe's card. Here, if you can see it, there you go. So if you add those together, he was paying $448 a month for those cards, but no longer is because they're paid off. So what's he going to do? Pay himself back. He's going to put that $448 a month payment back to himself, refilling his account. We're just redirecting who he's paying that money to every single month. So your number 2 comes around, deposits 25 grand again. His cash value he has access to is 16,500, right? Cash value is more because he's compounding. He also paid himself back $448 a month, which is 5 grand essentially. So he took the cash value plus his loan repayments, and he has $21,000 in total. And what's he going to do with the new monies? Pay off his debt. All right, paid off those 3 loans and most of the BMW. He just paid off some big payments he was making. He had 276 for endorsement, 271, 922. Those are some big payments he had that now are gone. And so what's he going to do again, guys, is start repaying himself that. Now he's saving $1,917 every month. Every single month he's saving that, which is going to pay himself back. So let's keep going. Year number 3, deposits 25 grand. He has access to 25.5. Cash value is growing. He also repaid himself $1,900 a month, which is about 23 grand. So he had $48,000 this new year. Then go pay off the BMW and the boat loan. Now take a look. All that's left is the house and the condo. And now he's paying himself back $3,600 a month. And he's only paying $2,100 a month in debt payments. It's pretty freaking awesome, right? 3 years in. It was going to take him 19 years if he was going to stay on his regular path. Now, we talked about this being a marathon, right? This takes a long time. This is a generational wealth type strategy. This is not a get rich quick scheme. Over those first 3 years, how much money did we put in? 25 each year as premiums for a total of 75. How much did we take out in loans? 14 in the first year, about 16 in the second year, and about 25 in the third year. So he took out 55 grand of loans. So question for you guys, how much is left over in the policy? Does this mean that 20 grand is left over? I hope you guys remember, it's not the case. You still have your full $75,000 sitting in the account, compounding interest. The insurance company is letting you borrow money against your dollars, okay? Basically what we're doing is the car example I gave you in the very, very beginning. You can earn more money earning 4 while paying 6. Same idea. Your 75 grand could be earning 4%. You're paying 6% on your 55 grand of loans, but you're making a spread. You're earning more because you're compounding. So you still have that 75. And yes, it makes sense to take loans against yourself. So let's go to year number 4. How does he continue on this path? Year number 4, deposits 25 grand in. His cash value increases by 26. He also repaid himself $3,600 a month, so total about 44 grand of payments. He has $70,000 in cash this 4th year ready to pay down his debts with. Throws it on the condo, doesn't fully pay it off, but almost does. Does it again the 5th year, pays off the condo. House is the only thing that's left going into the 6th year. One thing I will say with this is there are some limitations of how you can actually structure and fund these type of policies. After 5 years, the IRS said, hey, you're only allowed to put X amount of dollars into this new policy. You can no longer put in 25 grand a year. You can only put in 10 per year. He had to decrease his premiums, which he did, but he also came to us and said, hey, I make more money now. Like, can I do another policy? I want to get this new policy on my wife now. So he did. He put in 25 grand a year on a new policy. So let's show that. He put in 10 grand as premium on the first, 25 in premium in the second. He had cash value available in both. He also repaid himself a crap ton of money every month because he's now repaying himself. So at the end of the year, he had access to 82 grand between his policies and the repayments, which again, guys, what's he going to do? Pay off the debt. Woohoo! Debt free in 6 years when it was supposed to take 19. Now he's repaying himself all of that $5,700 a month. I hope this is sinking in. This is a different example, about debt, but I'm sure this is more relatable. What if you have no debt though? What if you don't need a new car? Can you still benefit from privatized banking? Should you still become your own banker? Well, I'll be honest with you guys, that's where I'm at. I don't have any debt really. I don't need a brand new car. I'm investing in real estate, like I said in the very beginning about myself. So I'm running rental properties and lending all through my policies. And so now it only gets more fun. The more you can do through your policy after debt's gone, the better you can utilize it. So let's go back to the example. If we continue to pay back the homes as promised, I just want to show you the effect of what you're doing here, guys, by paying off your debt faster and repaying yourself. He was going to pay $879 a month for another 251 months to pay off his condo. And same with his house. He had a lot of time left on them when we paid him off. He was going to pay a total of about 500 grand left over he needed to pay. But by using this method, he now is able to pay himself that back. Wouldn't you rather have that money back in your pocket compared to someone else's, right? It's pretty simple. Now that you know this is possible, should everybody be doing this? Should you be doing this? Why don't more people talk about this? Guys, 100% 99% of you on here probably should be doing this. If you don't do this, you're just going to continue on the same path that all of us Americans are groomed to follow. We're just stealing from our kids and our grandkids. That's really what's happening. Guys, wealthy people do this for a reason because they know what it can do and they all understand how to keep money in their families. We all need to break the bonds of financial slavery we have in America. If we don't, we're just going to continue to be stuck, continue to be in debt, not having success, and then we'll become like the 95% of people that are not financially secure. So when you do this, you're not just setting yourself up, but you're taking care of those around you. Infinite banking is this concept we've been discussing, which is another name for it. The money multiplier method, infinite banking, same thing. It's just the concept of control, controlling our money. It's also about finding ways to get money to go work for us and stop working so hard for our money. So to finish up, I want to break down some things I did not get to today. And then we'll get to all of your questions. So as I go through this, write your questions down and then we'll get to them in like 5 minutes. All of these things I kind of mentioned throughout, but I want to hit them again. Your policy is going to grow tax-free. The death benefit that gets paid out will be tax-free as well. Your policy is exempt. You can use the policy for all kinds of things as well. Income for retirement, policies on children, colleges, paying for businesses. You can use it in all kinds of ways. How do you fund your policy? At any frequency you want. Monthly, quarterly, annually, semi-annually. The minimum I would recommend to run into your policy would be 10 times your age a month. I know that's a common question. Minimum and maximum. What are the ranges of how much I can put into this? That's the minimum. If you're 50, add a zero, 500. $500 a month is the minimum you should do if that's your age. And the max is going to depend upon the individual, their net worth, their businesses, and et cetera. But I've seen people put millions of dollars into these policies. So you have a wide range of how you can do this. And on top of the regular premium deposit, you can do a large lump sum to start the policy. So let's say you're doing $500 a month, and then you're like, hey, I actually have another 50 grand sitting in my savings account, losing value, or my 401k. Pull that thing out and dump it into the policy to get it started. You can do that as an upfront lump sum. And the cool part about it is you'll have access to 60 to 90% of your dollars day one once your policy's funded. It's that quick. We call these policies high early cash value policies, HECV. These allow you to become the bank very fast and do things very quickly. You cannot get a policy like this at your local insurance company, your local agent, your brother-in-law. You can't. You have to get a policy built for banking from someone who teaches and does banking like us. We have people come to us all the time who have an old policy or someone sold them something or they got some random IUL and they're sold these things and they have no idea how to use it. It's not set up right. And they think it's used for banking. It's not. Whole life insurance is not banking. It's just the vehicle we use to do banking. So you need to set up the policy right to do that. Now, when you take policy loans from yourself, I want to hit that really quickly because it can be confusing to some people. So your cash value in the policy is essentially just the amount of money that you have access to loan out. Policy loan, cash value loan, interchangeable wording. Same thing. These policy loans are guaranteed. The insurance company can't say, you don't get the money. No, it's yours. Guaranteed in the contract. That money is yours to access whenever you want. You can take the money out whenever you want and pay it back however you want. You can take as many loans out as you want. It's like one large line of credit. When you look at a line of credit at the bank, you can pay it back when you want. And when you pay it back, that money is available for you to use again. It's just like that. As well with these policy loans, there is no credit check or approval. You ask for a loan, you get it. They're private. They don't go on your credit report, which is nice. Because if you have a low DT or a high DTI, you're trying to qualify for a mortgage. Get rid of all your credit cards, all your bad debt, throw it inside your policy, have your policy pay it all off. Now those loans are gone off your credit report. It's in the private policy, your private loan to yourself. And you then can choose to pay it back how you want. And there's no minimum or maximum of how you pay your policy back. You're in complete control because you're paying yourself. You can pay yourself back monthly, annually, one large windfall of cash someday in the future, however you need it. And what if you missed paying yourself back? Who cares? You're the one in control. Nothing's going to happen. If you stop paying your car payment, someone's going to come and take it from you. That's not going to happen with this if you loan it from yourself. So why the money multiplier, guys? Before we dive into questions. First off, I will teach you how to implement this strategy completely free of charge. That's right, for free. My team and I do not charge anything because we are paid from the insurance companies for the business that we bring them. So we're already taken care of in that way. I will never manage your money, invest your funds, touch any of your dollars. You will honestly do all of this on your own. You're going to go to an insurance company and set up a policy, use it, pay things off, invest in things, pay yourself back. We are just a third party to help make sure you do this correctly, help you set up the right policy, help you pick the right insurance company, help you use the policy and plan how you're going to do things. That's our role in all of this, teaching you how to become the bank. We're not the insurance agent. We kind of are, but we are also here to teach you how to use it. And I personally have met with over 2,000 families one-on-one all across the country to show them how to build their own strategy out. Between our whole team, we've met with over 20,000 families. A lot of people are doing this, and we are essentially leading it. We are the largest producers of infinite banking policies in the country. And that's because we have a lot of repeat business and a lot of referrals because we treat our clients right. We're not here to just sell a policy, but teach people how to use a policy to become the bank. We offer something that financial advisors and life insurance agents don't. We even have dedicated underwriters and some special policies at insurance companies that work for just our clients because of the relationships we built with those companies, which is pretty cool. Last thing I want to say here is I bring it up because it gets a lot of attention. I've mentioned it a little bit already, but is an IUL or a VUL or term insurance infinite banking? The short answer is no. IULs and term insurance pay some of the highest commissions, which is why insurance companies push their agents to sell them. They are not meant for banking. They're not bad. There's purposes to those insurance policies, but they're not meant for banking. It's a different conversation. If you want to dive into that more specifically when we meet, we can do that. So to finish up, only one of two things are going to happen to us throughout our life, guys. We're going to live. I should say one of two things will happen. I say both will happen. We're going to live and we're going to die at some point, right? So are we better off with or without this while we're alive? Well, I just showed you, you're going to get money back on purchases, pay off debt faster, multiply money in investments. You are better off with this than without. Is your family though? Well, when you pass away, guess who's going to get a fat lump sum check for free, tax-free? Your family. So yeah, they're way better off if you do this than if you don't. And I'll end with this quote by the richest investor in America. If poor people would just do what rich people do, they wouldn't be poor anymore. It could be a poem. Do you guys wonder why Warren Buffett owns Berkshire Hathaway, which has an insurance company? Because he's genius. Today, I talked about the wealthiest families, the corporations, the banks that do this. If we just copied them, we would in fact not be poor anymore. We'd be building generational wealth. So you guys are on here because of Chris Naugle, I would assume, and maybe an ad you saw. He's asked me to teach this to you guys because it is impactful for him. It has helped him build his empire and helped me start and build mine. And so today, I want to give you guys that opportunity. This link right here goes to my personal calendar. The QR code on the left, if you pull out your phone and the camera and scan the QR code, if that's what you rather do, that goes directly to my calendar as well. And on the right side, that QR code goes to my Instagram for you to follow and watch all my journey of teaching real estate, teaching IBC, and how they combine, because that's what I do. So I want to open up the rest of this to questions, and I want to tell you guys that this is a time for you to make a decision. Now I know you might need to do more due diligence on the concept, the policies, us, which I completely respect and agree with. So reach out to us. Let me send you more information for you to learn. Let me send you books, YouTubes, podcasts. Let's have a one-on-one conversation where we look at your entire situation and see if you're even fit to do this. So let's end it here. I'll keep my QR code up there for a minute for you to scan and pull up my calendar if you want to meet one-on-one, which probably all of you should do. Even if you have an old policy that you think could possibly work for this, it might not. You might be able to use it more efficiently. You might be able to roll it over into something better. So even if you have an old policy, let's look at it. Let's talk about it. Let's see what we can do. All right. I'm going to give you guys a couple minutes to pull up your questions. I see a lot already, so let me start going through them. We have about 15 minutes, guys. Someone said the QR code is deactivated. I do not know why. So carson.beyourownbanker.com. Instead, just click that link I threw in the chat. I don't know why it's deactivated. I'm sorry about that. Click that link in the chat, and you can. I have some time available tomorrow, I believe. And I have plenty of time I opened up for next week for any of you that want to meet. And if you do book with me next week, I can send you more videos to watch this week. So by the time we talk, you're like ready to go and more understanding. So there's that link. I'll throw it in there. I also have my email address that I'll throw in here as well. Just threw it in now. Do you have a simple question that you're maybe a little uncomfortable to ask on this, group environment? Shoot me an email. Just say, hey, I was on the webinar, had this question, please get back to me when you can, and I will get back to you. I want to answer your questions. So you can do that, email me, book a call, whatever you feel, and then we have a few minutes now to answer those immediate questions. So let me get into that. Jorge Montero, about 10 minutes ago, asked, how do you buy whole life insurance? That would be me. I mentioned it earlier. If you go to an insurance company or your local agent down the street, they will give you a regular off-the-shelf life insurance policy. They will not give you a banking policy, so you cannot go to them. If you do, you talk to them about it, even if you explain the concept to them, they will not understand nor teach you how to use it. We get this every single day, so I understand. But we build these policies for banking. So if you do want a whole life policy, you want to learn how to use it, book a call with me. I will show you how to do so, or someone on our team. Any of us can help you. Someone asked in the chat, how are you guys doing velocity banking? What vehicles are you using? Whole other concept, might take a while to dive into that. But to those of you who don't know what velocity banking is, don't worry about it. But to Robert, you can use a credit card, lines of credits, and HELOCs. A personal line of credit, business line of credit, home line of credit, any kind of line of credit or a credit card that has a simple interest rate to do banking with. To do velocity banking with. Again, guys, if you don't know what that is, don't worry about it. It's a different concept. What documents are required to take out a loan from your policy? LD Swift said. The insurance company, basically, you'll have an online portal with the insurance company. And on that online portal, you can fill out a form requesting a loan and then send the funds to you via ACH transfer in like 2 days. So very fast. Best insurance companies to do this with. Mutually owned life insurance companies. Anthony is correct. He did say, though, the top 4 mutually owned life insurance companies are New York Life, Northwestern Mutual, Prudential, and Metropolitan Group. Those are all great companies, but you actually, sorry, Anthony, you can't use any of those companies to do banking with. Kind of funny. Strong companies, yes, but you can't do banking with those companies. So you cannot get a policy there. They will not build a policy that has uninterrupted compound interest, or they'll not build a policy that has tax-free growth or enough cash value in the first couple of years, or they'll give you a different type of policy like an IUL or a term. They don't build policies like this. Northwestern Mutual is a big one. People think you can, you can't. They actually charge or pay you less interest if you take loans out. It kind of disrupts the whole process of trying to earn a compound interest. Same with, well, actually, New York Life could possibly work, but they are the same thing. They're what's called the direct recognition insurance company, where they will not pay you enough interest if you take loans out, which is not what type of companies we want to work with, because we want to be earning interest while taking loans. Celia, what's the process of setting up a policy? Book a call with me. Again, email me your phone number and I'll reach out to you, whatever you want. Anna, I see we actually have a call next week, so I'm stoked to meet with you next week. But you asked a question about the interest we're paying on the policy loans. If we decide to not repay policy loans, are we continually charged interest? Beautiful question. That is a yes. If you take a loan, you owe interest on it. Just like a line of credit, as long as you have it out, you're going to owe interest on it. And if you don't pay it back, it will accrue. So that's why we say you should pay yourself back. You should be an honest banker with yourself. At least have a plan. If you're like, hey, I'm buying a house and I'm going to flip it and sell it in 2 years. Okay, great. Don't pay yourself back for the next 2 years, knowing profits coming back, right? You can pay yourself back however you want, which is the great part about this. You have flexibility. And so you don't need to pay back every single month, but you just need to have a plan, I would say. Yes, LD Swift asked around about an hour ago, when do the banks insure? Who do the banks insure? Banks have so much life insurance because they insure every single owner, manager, employee of the company. If you walk into your local Wells Fargo, look at their name tag. Unless they're the teller, anyone in a cubicle has a name tag that says Vice President of blank, because they are a key employee of the company. So they need to have life insurance. Banks put policies on everyone. It's genius. So if you are a business owner, you could look into doing something like that as well. Not just a policy for yourself, but incorporating it in your employee benefit plan. All right. Question was asked, saving 10% of what? Take home pay or before taxes? I asked saving take 10%. Yeah. So this is, I mean, it depends on your situation. I would say save 10% of your take home pay. Save as much as you humanly possibly can. It's like those people who are like myself. I'm a big gym goer. If I'm trying to gain weight, I need to take in more calories than I lose. And then there's going to be an increase in calories, increase in weight. If I'm trying to lose weight, I'm going to eat less, take in less calories than I burn. Or yeah. And so same idea with money. If you want to gain money, you just have to save. I know that's a duh for most people, but it's the truth. And a lot of people don't do it. So it needs to be said. Okay, Celia, I see your message here. I'm throwing a link at the bottom. So you click that link and you can book time with me as well. It'll go directly to my calendar. You'll get my phone number, my personal phone number, my email as well. A couple more questions. Can I set the policy inside of a solo 401k for self-employed individual? So you cannot. There's a difference between qualified money and non-qualified money. Okay. So your 401k and any retirement account that you can't touch until you're 59 and a half is what's called a qualified plan. You cannot touch it until you're 59 and a half. And so there's a difference between qualified and non-qualified dollars. You can't roll them over to each other. They don't work. You can always put more money into your qualified plans, but you can't go the other way. And so you would have to choose. Do I want to do a solo 401k or do I want to do a policy? And if you were to ask your CPA, they're going to say 401k because you're going to get tax write-offs. But what's the CPA's job? To have you pay less taxes. That's their job. So they're going to tell you the answer for you to pay less taxes. But that doesn't mean they're strategizing for your financial future with you. They're just telling you how to pay less taxes. So you can't ask a CPA those type of questions. Should you contribute to a 401k or a policy? Well, that's the question for yourself to figure out. What are your goals? What are you purchasing? What are you investing in? If you're going to be buying rental properties or lending money, you can't do that in a solo 401k unless it's self-directed. And then you're just postponing the taxes. So why would you do that when you could rather do those things now, pay the tax now? I'd rather pay more tax today so that it can grow tax-free forever. Pay the tax on the seed, not the harvest. 401k is paying tax on the harvest. I don't care what they say. Even though they eliminate taxes today, who gives a crap? So that's totally up for you to decide. I've seen people go both ways with it, not do 401ks, do 401ks and a policy, whatever. It just depends on your investment strategy. If you love a Roth IRA and you love investing in dividend stocks, you don't ever plan to pull out of it, why would you run that through a policy? Right? But you only can put $6-7 grand a year in a Roth IRA. So depends on your situation. You could do both. And that might be a good topic of discussion if we were to meet and talk about it. I could help you determine whether it makes sense for you not to or to. And I come from that space, actually. So I mentioned, a little bit about me, but if any of you have heard of the company Horizon Trust, it is a self-directed custodian company. My dad owns that company. He teaches and speaks on stage all over America, teaching people how to unlock their money in retirement accounts. He helps people self-direct their retirement accounts. And so that's actually the background I came from before I found out about IBC and unlocking and controlling your non-qualified dollars and your purchases and investments that aren't in retirement accounts. And so I understand both games, both worlds. I talk about it all the time. So if we want to have a discussion about that, I would love to. All right, another couple questions. What if something happens in my future, I lose a job or something, and I can't pay the premium, or I want to decrease my contribution amount? That is possible. You can decrease your contribution amount any year. And actually, after 10 years, you don't have to ever contribute to it again, ever again, if you don't want to. You probably would, because the policy will be growing by so much you'll want to, but you don't have to. So yes, there's ways to do less or more premium, stop paying premium. You have a lot of flexibility with it. Another question, can you just do a yearly transfer from a 401k after 59 and a half without issue while employed? Yes and no. It depends on your employer, and it would depend on the situation. If you're older than 59 and a half, obviously there's no penalty, which is nice. You will owe tax, you can pull some out, but it will depend on the employer, depend on your taxes. So that question specifically, I'd almost say go talk to your 401k administrator and your CPA to find out. Can I put my business in one? Brad said. So your business can own a policy. Yeah, but the business would own a policy on a manager or employee, which would be you. So you would still be the policy. It'd be on your life. The company would just fund it for you. And the company would use the money for whatever, equipment or equipment financing or business investments or real estate, whatever. Another question, this is a little bit more of a complex question. So those of you who don't understand this, that's okay. If my policy is full with paid up addition riders and premium, what can I do with my interest that I'm paying myself? So let me see actually really quick. Roberto, I see your message. You said the link's not working. I just clicked it and it did work. So instead, if you can't get that to work for some reason, just email me on that email right there and just say it's not working, and I'll book time with you specifically. Stacy, if my policy is full with paid up edition riders and premium, what can I do with my interest that I'm paying myself? So if you're paying yourself back, you're paying your premium, and you've already paid the full premium this year, you've already paid back your policy in full, and you have no more money you can put into this, good for you. Time to set up another policy. Just like banks add branch offices in every new town, you need to add new branch offices. Set up your second banking system. Go insure a spouse, a child, or yourself again, or a business partner. Add more policies when the time's right. If you are paying yourself in full, paying your policy back, it's time for another policy. All right, a question from a few minutes ago. Are you and Brent Kessler on the same team? Yes. So Brent Kessler and Chris Naugle own this company together, and we teach the same concept. The money multiplier is our company name. We teach infinite banking. So yes, we're all on the same team. If you've seen Chris Naugle on Instagram, or Devin Burr on Instagram, or Hannah Kessler on YouTube, like, we all are on the same team. We teach the same thing. And so, yeah, don't get confused. Someone asked, what's your address in California? I'm in Southern Orange County. If you know the town Dana Point or San Clemente, very south Orange County, where the surf spots are. Someone else asked, what is the usual break-even point? How many years does it take for your policy to break even? Depends on you, depends on how much you're putting in up front. I would say between years 2 and 5 on average. And we're wrapping up here. I got to hop into a meeting in 2 minutes. So I'm trying to get to all your questions before I do. How much can you put into a policy cap? Depends on your net worth, but typically 25% of your gross income. You make 100 grand a year, 25 grand a year is the most they'll let you put into it. Once I have about cash in the policy, I can close a bank account. So you do not close your bank account. You do not get rid of your checking account or your checking account. You just minimize how much is stored in those accounts and maximize how much is stored in your policy. So you'll keep a checking account, you'll keep your Wells Fargo or whatever. It's just now, instead of that being your savings, this is now the savings account. Now, anytime you need to finance something, invest in something, it comes from your policy. All right. I think that's good. I do need to hop off. So I'm grateful for all of you being here and spending your day with me. If you do have questions that are more than what I've said, let me, again, throw it in here again in case you don't want to scroll through the chat. My phone number, my email, my calendar link, all that's right down here at the bottom. And so if you do want to talk, have questions, need more resources, more videos, whatever, message me. We can talk. Next Tuesday, I will not be here. There will be a couple other people doing the presentation, but it will be the same presentation each week, every Tuesday. This is the main presentation, IBC 101. So if you have someone you want to learn this from, send them this recording or have them join our conversation. Let other people learn the concept too. So we're good to go. All right, guys. Thank you for your time.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.